All right, we'll go ahead and get started. I want to thank everybody for taking time out of their day and being here with us at lunch or Lunch and Learn for November. I do want to say we're going to take next month off. So this will be the last one for 2021. And then we will pick back up again in January. And we're going to do a little different today. We've got kind of three things we have on the program today that we want to talk about. First, we're going to have some of our producers and brokers. We got two that are going to talk to us a little bit about how Broker House has helped them and what we do for them. That will be first. So we have Shelley Long and Tom Marsh to do that. One has been with us a very short time. The other has been doing some business with us for some time. The second thing we're going to do is I'm going to talk a little bit. I know we have a lot of property and casualty agencies in the group. So I want to talk a little bit about how to position auto owners in your practice, because I know you get a little bit of pressure to sell auto owners policies or Grange or whoever you may have in the agency in order to qualify for trips. And then lastly, we're going to talk about an idea, a sales idea that Todd is going to bring to us that is probably very timely considering we've got the Christmas holidays coming up. We're going to talk, and really when we get to these sales ideas, and we'll present these to you as we go through our lunch and learns in the future, but we're not necessarily want you to know everything there is to know about the sales presentation or the sales concept. What we want you to be doing is having out a piece of paper, thinking about your prospects that the sales idea might fit. And then we can come in and help you make the presentation and answer your questions. So those are our three things today. We're going to have a couple of producers talk to you. I'm going to talk to you about auto owners, and then Todd is going to talk to you about some generational planning. So I'm going to start, and I'm going to ask Shelley Long of Lemon Moeller to take the mic and talk to us a little bit. She's fairly new at Broker House, so I wanted to let her tell you about the things that we've been doing for her. So Shelley, if you would, please.
Okay, I had to unmute it. It's Shelley Knox, by the way.
I'm sorry, what?
But Knox.
You know, I've done that before, Shelley, because I guess
Shelley Long is the actress,
person, right?
Yeah,
I said,
right.
I said that to Jenny, and she knew exactly who I was talking about. So I apologize.
Yeah, you just totally dated yourself. But I know she was too, so don't feel bad. Yeah, so they asked me to talk a little bit about what I've done since I've been working with Broker House. So mainly, my main line of business is personal lines. I sell mainly auto, home, boats, all those kind of things. It's my main line of business. And so the life insurance is something that the agency is kind of taking a more active role in trying to sell. And so how I've approached it, since I have so much access to people buying new homes, is when I'm quoting the homes, I'm asking them if they want mortgage protection. And then I explain what mortgage protection is, mortgage company, where it just is the loan. And then I say, you can get a policy that will cover you for whatever amount you want. And then if something were to happen, then the beneficiary can pay off the house or do whatever they want with the money, but they're in control of it. And it won't be just the amount of the mortgage, it'll be the total amount, like it's 100, 200,000. So that's kind of how I get it started with them. Then once I get that going and then they're interested in the quote, of course, I get all the information. And then that's when Broker House steps in. So I go on their website, and I've kind of done it two different ways. I've quoted and written a few. The best way I like to do it is to actually run some quotes. And then when I get those quotes, I shoot them over to David, which I'm like, can you look at these? And everybody there at Broker House is a lot more familiar with all their markets and what might fit better at one company, whereas not with another. And so he would give me the options of what would be best, and I'd sell it to the customer. And then I'd just do a drop ticket with Broker House. And from there, they took care of everything else. It was like the easiest process ever. I mean, we are new as an agency, so there were some issues about getting us licensed and taking exam, or the things that we're supposed to do for Broker House. But once that was all done, I mean, the process was really easy. And what I really liked about it is that they kept me informed the entire process. So one particular person, there was a lot of things she had to get, stuff from the doctor, form signed, whatever. They took care of all that, but if they had it, they kept me informed in the whole process. But if they had any issues, like they couldn't get they weren't signing it, they'd reach out to me and ask if I could help, and I'd get them to sign it, and then we'd move on. But they literally kept me informed the entire way through the entire process, all the way to the end. Katie Cook is the one who was really helpful with that certain person. She just was on top of it and helped me. And, when I get an email, I didn't really understand what it was. I'd email her back. I'm like, what is this? And she'd say, well, they're just explaining this is where we are in the process. And so they really worked it very well. The other way I did it was where I went and just quoted it myself, found a company, did the application, submitted it all. And then I just emailed David, because I emailed David for everything. I'm sure he just loves that. But I emailed it to him, said, hey, I just submitted this, just want to make sure everything's right. And so everything went smoothly with that one as well. However, I wrote somebody, a friend of mine, and he lives in Georgia. And then it come to find out that, I'm obviously not licensed in Georgia, I'm in Mississippi. And so I wasn't able to actually be the licensed agent on it. So Ralph stepped in and said, well, I'll be the signed agent on it, and took that over for me so that I could get paid commission on it. So I thought that was really pretty awesome of them to do that. I wasn't even expecting to get paid the commission on it. David just told me yesterday, and I just assumed they were just taking it over. So that was even better. But my point is that everybody there is Ralph, Katie, David, Deanna, all of them. They're just really helpful. The process is super easy if you just listen to how it works and just do that drop tip and then let them do the rest. And I've really enjoyed, what we've done so far.
Well, thank you. I appreciate it, Shelley. Thank you for the kind words. And now the other one we want to have just take a couple of minutes is Tom Marsh. Tom has been doing business for a good period of time with us. So Tom, tell us about your experiences. We can't hear you, Tom. Have you got your volume turned up? Still can't hear you, Tom. All right. I think what we'll do is maybe with Tom, we'll try you next time. We'll get you on the call in January. That's okay. Thank you for volunteering. We'll get like I said, technology is great till it doesn't quite work. Okay. So we'll move on, and we're going to talk about where auto owners fits, because I know a lot of you. Oh, Tom, was that you? I was getting some feedback. Okay, I want to talk about where auto owners fits, because I know a lot of you are in P&C agencies, and it's my understanding that two things happen. You have to sell a number of life policies in order to have the principals of the P&C agency go on the auto owners trips, which I understand are very nice, and they take care of you quite well. And secondly, if you have a P&C client who has auto owners P&C, they do get some discounts on the P&C if they have a life insurance policy. So what I'm going to do right now is I'm going to show you where auto owners fits. I ran a couple of different illustrations. Let me see if I can share my screen here. So if everybody sees this now, it should be the annual premiums for a 45-year-old male, standard plus non-smoker. Does everybody see my screen?
Yeah.
And I did $250,000. I did $500,000 just to show you how auto owners compares with some of our companies that we represent. So I'll just look at this, a 10-year 10-year, $250,000 term policy with auto owners is $540 per year. That same underwriting class with Banner is $337. It's about $200 cheaper than auto owners. And we've got about 10 companies that would be $200 a year cheaper than auto owners. If you go out here and you go to 10 years or $500,000, now the premium is about $400 a year difference. So your auto owners for the larger face amounts becomes more and more expensive. Now, I understand you want to try to get a discount for them on their P&C coverage, but it's my understanding they give a 5% discount on personal lines and 2% on commercial. So if you have a personal lines person who buys an auto owner's policy, for each dollar that you would have saved with Banner, so in this particular situation, I'm showing you save them $200. Every dollar equates to $20 of P&C premium that would have to be discounted. So that $200 savings, you'd have to have a $4,000 a year P&C premium for that client to be in the same position as having bought the Banner policy instead of buying an auto owner's policy and getting the 5% P&C discount. If it's a commercial account at 2%, it has to be 50 times the difference. So $200 savings times 50 it'd have to be a $10,000 P&C premium. Now, if I don't have those discounts right, please let me know, but that's my understanding. So I don't know that you really want to sell sell auto owners at the larger face amounts. Now, where auto owners would fit would be the smaller policies like at 100,000, 50,000 or something such as that. Because the companies that we have, it's hard for them to really compete down in the less than $100,000 of coverage. They can, but the number of companies we have really constricts once you get below 100. So let me repeat that. If you're looking to save them on their P&C premium, you take the savings, they have to multiply by 20 on the personal lines, and the P&C premium has to be over that number in order for it to be a better deal for the client. On commercial, it's got to be 50 times. Now, again, I think you're better off selling them a $25,000 auto owner's policy because it does everything. Auto owners calculates everything based on policy count. That has nothing to do with premium or face amount. So by selling that person a $25,000 policy and then go outside and buy a $250,000 Banner policy, you've accomplished everything you wanted to do. You've sold a number of policies with auto owners. You've gotten them the discount on the property and casualty, and then you've got them one of the cheapest rates out there for the Banner policy. Because quite frankly, if you sell your client this $540 premium, it's very easy for them to go out and make a look on the internet or a one Google search, and they'll find that $337 premium. It's pretty easy. Now, I did it for a 60-year-old too, and look how much difference it is. On a 10-year term, it's almost $700 a difference between auto owners and Banner. And if you go to 500, it's $1,300. Fairly significant differences. So then the question is, where does auto owners fit? I think it's about 3 or 4 places. It's the smaller face amounts. It's for their long-term care and their disability. And then also they write a lot of small children's policies, okay? If a grandparent wants to buy a $5,000 or $10,000 policy, then auto owners is a good place to do that. Because like I said, I do know you got to sell your 8 or 10 policies with it. Now, with that said, talking about children's policies, we're going to find some parents and grandparents who want to do something more for their children than just have a $5,000 or $10,000 policy. So what we're going to talk about now is I'm going to flip it over to Todd, if I can figure out how to do that.
Perfect. Thank you. Well, welcome everyone. I'm sorry for that little delay. This afternoon, we're going to talk about a concept that sounds very fancy. It's called multi-generational legacy planning. But before we get into the concept, I wanted to talk to you and have you focus on who the potential prospects are for this type of a strategy. So with multi-generational legacy planning, it refers to 3 generations that we're going to be talking about. Generation 1 are the grandparents, and that's going to be the generation that pays the premium in a life insurance policy that will be written on the adult grown children of Generation 1, known as Generation 2. They're the insured in the policy for the ultimate benefit of Generation 3, which are the grandchildren. So the prospects that I want you to think about, that you may know some people like this, and I want you to think as we go through this discussion, what clients do you know that might fit this type of a scenario? So the first prospects are going to be Generation 2, who are the insured in the policy. And these would be individuals that may be doing very well. They may be making a very good income, but they could be spending everything they make. They might drive a fancy car. They might live in a big house, send their children to private school, go on regular vacations, have a lake house, etc. But the point is, they're not saving money for future goals and for benefiting future generations. The next prospect would be Generation 1, the generation that will be paying the premium. And these individuals might have their home paid for. So one thing to consider would be that the mortgage payments they've been paying for many years on their house, they no longer have to pay those payments. That could be used as premium to pay into this policy. These would be people that are comfortable. They live comfortably, but not necessarily extravagantly. They're kind of what we would call old school. They are financially secure, not necessarily super wealthy, but they're, as I said, they're comfortable. So the concept, we call it multi-generational legacy planning, which again sounds very fancy, but what it is simply a lifetime wealth transfer strategy. Most people think about transferring wealth when they die. So they might think, a life insurance policy is going to leave money for their children and grandchildren, or their assets. But in a lot of cases, it actually makes sense to transfer some of that wealth during lifetime, because it can have tremendous benefit and impact during their lifetime. So what I want you to consider is that a lot of grandparents are looking at the world today, and they're very concerned about all the chaos that's happening, and they're looking at their grandchildren and thinking, are these kids going to have the same opportunities that we've had? Are they going to be able to achieve the level of comfort that we've achieved? So here are the scenarios, and then we're going to look at a sample case. Generation 1 is going to pay the premium during their lifetime. It's typically going to be done over 7 to 10 years of paying premium. Generation 1, the grandparents will maintain control over that policy during their lifetime, and upon their death, the policy will be immediately transferred into an irrevocable trust. The typical scenario in this situation would be Generation 1 would be people age usually 60 to 70 years old that, as I mentioned, are financially secure. They may not be insurable, so that they don't have to be healthy. Generation 2 are the children, the adult children, who will be the insured, and they're going to be usually 35 to 50 years old, and they will be healthy and insurable. Generation 3 are the grandchildren, who could be babies to teenagers at this point. So the purpose and uses of this strategy are for generation 3 to have money available for them to go to college, potentially to help them start a business, to pay for a future wedding, or potentially a down payment on a house. For generation 2, there may be some tax-free retirement income for them when they retire. As I mentioned, this policy must go into a trust, because if it's not in a trust, then it potentially can cause tax problems. So you don't need to worry about all that right now. You just need to understand kind of the big picture of this scenario. Always know, for example, that your job is really to begin the conversation, and we can help you design a presentation and help you with how to show your client how it all works. So let's take a look at what a sample case would look like. And please confirm everybody can see my screen. I want to just make sure that you can see it. So this is a sample case. It shows what this strategy does, which is provide financial security across generations. It mentions some of the reasons that this type of a strategy is necessary these days, which includes skyrocketing college costs, student debt, employment challenges, delayed home ownership. It talks about the different generations. Generation 1, the grandparents can use assets more efficiently, maintain control, provide a legacy. Generation 2, the adult children have increased financial security, supplement retirement income, help to fund college for their children, save for weddings, start a business, etc., as I mentioned. And for generation 3, the grandchildren, it helps to provide protection, source of education funding, and improve financial well-being. So the idea is for this strategy to protect future generations, and this kind of gives a breakdown of how it works. Generation 1, the grandparents will purchase a permanent life insurance policy insuring generation 2, the adult children. And as the owner of this policy, generation 1 has the flexibility during their lifetime to access policy cash values as needed. But again, at their death, the policy will go into an irrevocable life insurance trust. Step 2, upon generation 1, the grandparent's death, the contingent policy owner, typically a trust, becomes the new owner and the beneficiary of the life insurance policy. Step 3, the income beneficiaries of the trust can include both generation 2 and generation 3, and the trustee can then access the policy cash value as the trust directs them to. And step 4 would be, upon the death of generation 2, the trust would receive the death benefit, and it would be distributed accordingly to the trust guidelines. But here's what it looks like. Here's our example. We've got the insured is a 40-year-old healthy preferred non-tobacco male. The grandparent is going to pay the premium for 10 years into this policy. So they're going to pay, in this example, $10,000 a year for 10 years. And in this example, we're assuming that today the grandchild is a couple of years old, and in year 15 from now, the grandchild is going to go to college, and the $20,000 a year is going to be taken out of the policy to help pay for college costs over a 4-year period. By the way, this amount buys initially $194,000 death benefit, which continues to grow and increases to $305,000. So at any time, if generation 2 were to die prematurely, there would be plenty of money for generation 3 to go to college, as well as do other things later in life. So college is paid for with this funding. And then later on, when generation 2 retires, they could take out $21,642 a year of tax-free income for 10 years in their retirement to help them with their retirement. And in this example, it assumes that there's a hypothetical death of generation 2 at age 86, and there would still be, after all that money came out of the policy, another $108,000 tax-free death benefit left for the beneficiaries. So this is a strategy that involves 3 generations. Again, generation 1 is the payor, generation 2 is the insured, and generation 3 is the ultimate beneficiary. But this is a way to transfer wealth during lifetime that gives a lot more value during lifetime, because there's leverage that can be utilized with a life insurance policy, and provides a lot of control and benefit for multi-generations. So I don't want you to worry about the details of the concept. I just want you to think about how this structure works and talk to your clients and see if they have any interest in this. And if they do, please contact Broker House, and we'll be more than happy to put a presentation together for you and to help you, hit the highlights in discussing this strategy with your clients. So I'd like to open it up and see if anybody has any questions at this point.
Let me say one thing too, Todd, on
Sure.
this, because I mentioned it was Christmas time.
Yes,
And if you think about it, this would be a great gift for a grandparent to give a grandchild and say, I'm going to put aside this $10,000 a year for 10 years. And really, to fund that $20,000, you may not have to put it aside that long, but he's going to commit to, say, 7 years, and that grandchild's going to get $20,000 for college when the time comes. Now, it may be that they don't take the money to go to college, or they don't spend all that money. Well, then when they get to be 30, maybe they can take the money out to buy their first home. So it's very flexible. But to me, it's a great present and a legacy to leave to their grandchildren. And what better time to do it than at Christmas?
very good point, Ralph. And this would be an incredible gift, because it's not just one time, it's securing a future for multiple generations. And it is a life insurance policy. There will be a large death benefit left, no matter whether they take income out during lifetime or just let the policy continue to grow in value. There will always be a benefit. So, are there any questions? All right, well, I hope that was helpful. Ralph, is there
I got
anything
a
else?
question. Hello?
Oh, yes.
Okay. With the generation 1,
Mhm.
okay, and after generation 1, grandparent passes away, it goes into an irrevocable trust, but this is funding whom? Is it the child, generation 2, or generation 3?
Okay, I'm not.
Is the death benefit for generation? You went over it pretty fast. Oh, there it
I'm
is. up
sorry.
there at the
Yes.
top.
Okay. So the insured is the adult child. So the death benefit is there when generation 2 or the adult child dies. That death benefit is what's left for generation 3. That is the net death benefit. That is a tax-free death benefit left for generation 3 when generation 2 dies.
Yeah. Also, let me make note that we're kind of assuming that generation 1 is not insurable.
Right.
You could actually do this with a policy on the grandparents. It probably would not perform as well as far as getting out that income for them, at college age. That's why we use the second generation as the insured. But there are a couple of different variations on this. I think what we wanted to do is kind of open your eyes to the opportunity that's out there, and hope that what we're talking about here, you've been able to think of a couple of people in your circle that would be interested in talking about this, and at least starting a conversation.
Are there any other questions?
All right, well,
All right,
if
well,
there, you
thank you,
can always
everyone.
email us
Yep.
or contact us by phone or email. You know, it's rmoore@brokerhouseins.com, or it's Todd Wachtel, which is TWACHTEL @brokerhouseins.com. Or as Shelley said, you can always send it to David. So,
Thank you,
and we'll
everyone.
get it
Appreciate
back
your
to
time.
you. And like I said, it's not that you have to know everything about this. It's just, you know, to start a conversation, you know, the grandparent, say, have you ever thought about leaving a legacy to your grandchildren that would fund their college education?
Right. It starts with a simple question. Yeah.
All right. Well,
Thank
thanks
you.
a lot, everybody, for your time. I hope everybody has a happy holiday season. Like I said, we won't be doing this in December. So the next time we'll talk will be in January. We'll get Tom on to talk next January. And then we'll have a couple of other, a sales idea kind of like this. Again, like I said, maybe you come with your pad and your pen and you start thinking about names and then you help, and then we get together and get in front of your client to talk to them and close the sale. So thanks, everybody. Again, happy holidays.